Hey, Bowtie Nation. Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern, every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, Friday's jobs report was ugly. Just 22,000 jobs created, and June was revised to show job losses. Stocks initially jumped on hopes for Fed rate cuts, then quickly tanked on recession fears. But here's the twist. That first reaction might have been the right one. I'll break down why, even if we can't avoid a recession, it could be the fastest in history, and your best opportunity to pick up cheap stocks, along with the 5 stocks I'm buying ahead of time. Stick around and I'll also update you on shares of Lululemon, Symbotic, SoundHound AI, and the market outlook for this week. But first, back to that main topic because Friday's jobs numbers confirmed the US is getting dangerously close to a recession, and even if we avoid the R word, it will affect the stock market, but maybe not in the way you think. The report showed the US created just 22,000 jobs last month, far below economic stall speed, and revised numbers showed job destruction in June, a loss of 13,000 jobs in the month. The initial reaction in stocks was for higher prices on the potential for bigger interest rate cuts from the Fed, but the market quickly crumbled as investors rushed to the exit before a bear market takes back some of the 77% return since the bull started charging 3 years ago. But I'm going to show you why that initial reaction, that higher stock prices, was actually the right one. Why even if we do see a recession, it's going to be very quick and a giant opportunity for investors, along with what stocks to buy right now. To do that, I have to go a little economics nerd on you, but I'm going to boil it down to the 4 main recession indicators: employment, industrial production, real retail sales, and real personal income. Now, the real in those last 2 means adjusted for inflation and is especially important right now. Analysis by Advisor Perspective studied the trend in each of these factors before every recession since 1960 and where the indicators are right now. And at first glance, none of these indicators looks like a big flashing warning sign. Employment is still rising each month, even if the unemployment rate is increasing a little bit because those new job seekers are more than jobs created. Real personal income is just 0.01% off its high in April, and industrial production is less than 0.1% from its high in June. It's really only the retail sales that are off meaningfully, down 1.5% from the high over 3 years ago. But it is the trend we have to worry about here. Employment is clearly falling, and the next few months will show more job losses than creation as employers get nervous. Retail sales have been weakening for years, but are about to get hit even harder by inflation. In third quarter earnings, which are going to be reported starting next month, profits at consumer goods companies are expected to have fallen by more than 2.6% from last year, a huge drop from the 5% earnings growth reported in the last quarter. Industrial production has been falling since June and is going to follow those retail sales and the employment weakness lower as companies try to cut back production ahead of a recession. And real income dropped hard in May with the first of that tariff inflation and is only going to get worse as companies try to pass on more of their costs to consumers. And now that analysis by Advisor Perspectives shows it doesn't take much to tip us into a recession. At the start of the 9 recessions back to 1960, non-farm employment was only down 0.01% from its peak, industrial production about 1% from its high, real personal income down 0.02% from its peak, and then retail sales were 2.6% from the high when the company tipped into a recession. That likely means that the downward trend in all of these indicators is very soon to be at a point or worse where we've seen a recession in the past. But now that initial reaction to the jobs report sending stocks higher was because we're likely to see bigger interest rate cuts from the Fed. The FedWatch rate tool already shows expectations for a 0.25% rate cut on the September 17th meeting, but after that jobs report, odds shot up to 12% for a jumbo rate cut of 0.5%. More than that, odds of future rate cuts increased, with the market now expecting 0.75% cuts in the year's remaining 3 meetings, and another 3 cuts next year. Nation, that is interest rates lower by 1.5%, and we're likely to see even more if the economy weakens, maybe even 2.5% or 3% lower rates. Here's where I think any stock market weakness is going to be extremely short and turn out to be a great buying opportunity. Household equity, the value Americans have in their homes, has boomed to $34 trillion, growth of over 72% from the 5 years ago. But because mortgage rates have been stuck above 6%, people just aren't refinancing their home, taking that cash out to spend or invest. Those Fed cuts could lower mortgage rates down to 4% over the next year and unlock trillions of dollars in consumer spending. Savers also have nearly $7.4 trillion invested in money market accounts, an increase of $2.7 trillion over the past 5 years alone. That money is earning a respectable 4.3% now, but cut 3% off interest rates, investors are going to rush out to earn a better yield on other investments. Now, much of that will go into bonds, but it'll push rates down there too, and a lot of that money is going to be looking in stocks for higher yields. And top this all off with the fact that while cracks are forming in some groups, overall households are doing very well financially. More than $4.4 trillion is sitting in checking accounts, near the record high and $3.4 trillion more than before the pandemic. Household debt service, so the amount of disposable income families are paying to debt, has increased, but is still well below the average of the last 40 years. Households are not overly extended in debt, and the coming cash wave from those lower rates will bring consumer spending surging back. I know it's a lot of analysis, and I love to nerd out when I can, but it's all to say that I do not want you freaking out as the pundits start screaming about recession and as stocks start selling off from this fear. With Friday's sell-off, we are down less than 1% from the all-time high on the S&P 500, but could see one of those normal corrections of 5 to 10% over the next few months. A 5% pullback would bring us back down to about 6,200 on the index, and I would wait for that point to do any buying in growth or tech stocks. Save some money back though, because a 10% correction would see us back down to 5,900 on the index and even better opportunities. I showed you in Friday's video the 3 sectors, healthcare, energy, and real estate, that are going to help protect your money along with the stocks in each that I'm buying. Now that list included Kinder Morgan, ticker KMI, Baker Hughes, BKR, Humana, ticker HUM, Novartis, NVS, and American Tower, ticker AMT, with others I'm also considering including Digital Realty, ticker DLR, Permian Resources, ticker PR, Eli Lilly, LLY, and EOG Resources, ticker EOG. All of these stocks are in sectors with reliable cash flows and good earnings outlooks, and the individual stocks are trading at attractive valuations, so these are all going to help protect your hard-earned money if we do see a hit to the market, especially those overpriced tech stocks that everyone has been chasing. But now the best way to protect your money without selling your stocks is going to be in option strategies. For example, if I want overall portfolio protection, I can go into the options available on the S&P 500 Market Index. I'll use the January options to protect my portfolio for the next 4 months, and see I can buy put options on the index ETF at a $645 strike price for just $19.82 a share. That means for just a 3% premium, I can sell shares of the SPY for $645 each, no matter how far they fall, basically making money on these put options if the market falls and then offsetting the near-term losses in my stocks. Another strategy that works well here when you don't know which direction the market will run is the straddle option strategy, buying call and put options so you benefit in either direction. Buying the January calls and puts at the $645 strike price would cost a total of $46 per share, but then would make money if the SPY moved 7% in either direction over the next 4 months. And you can use these strategies with individual stocks as well. If I'm worried about supermicrocomputers, ticker SMCI, then I can sell a call option on the $45 strike price for $4.28 a share, collecting that money and protecting my position from a 10% drop in the stock. If the shares dip further, I keep the stock and the cash for that protection. If the stock does head over $45 each by January, I'll make 11% on the stock plus another 10% cash return for a 21% upside in just 4 months. Nation, I know the options jargon can seem like a foreign language, but this is really your best tool for not just protecting your portfolio, but also increasing returns and creating cash. To help you get started, I'm relaunching our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through 29 option strategies, when to use each, and how to set it up, including real-world examples with shares of Tesla. The course also comes with a one-of-a-kind option strategy to help you find the right strategy, and then an options calculator to show you exactly how much money you can make. Right now, I'm relaunching this course at a 38% discount. Save $150 off, but only for the next 4 days. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'll leave in the description, so look for that link or scan the QR code here. Looking at the stocks I'm watching this week, Lululemon Athletica, ticker LULU, plunged 18% Friday into its lowest level in 6 years, and I'm finally ready to start watching this stock for an upside trade. Shares dropped when the company said inventory errors and a $240 million hit from tariffs will cut its revenue and profit outlook for the next quarter, but there could be a big catalyst over the next few months. President Trump has asked the Supreme Court for a quick ruling on his emergency powers for tariffs. If the court sides with the 2 lower courts in that decision, effectively negating 80% of this year's tariff increases, the administration is going to be forced to return hundreds of billions of dollars back to companies that have paid those duties. That could see Lululemon, one of the hardest hits by these tariffs, reverse out a lot of this 56% drop in the shares this year. Because of the huge swings, the premiums on options here are giant, so I would rather use an option strategy like maybe covered calls to reduce the risk and keep the upside return. Affirm Holdings, ticker AFRM, is now up 21% in just the 2 weeks since recommending it on the rate cut theme, and potentially more upside as this buy now, pay later leader sees its own borrowing costs drop, while getting a boost from better loan economics and merchant fees. Revenue is expected to continue at a 23% pace this year and next, and while the shares are getting expensive here at 9.5 times sales, I would be watching this for any dip buying opportunities. Shares of channel favorites Symbotic, SYM, and SoundHound AI, ticker SOUN, did surprisingly well on Friday, with shares of both AI companies up more than 4%, even as the rest of the market sold off. I continue to hold both the 4th and 7th largest holdings in my own portfolio. The fact that buyers stepped in while selling pretty much everything Friday is a strong vote of confidence for these two stocks. Now, that doesn't mean they won't dip as the broader market really breaks down, but I would definitely be buying on any opportunities. Circle Internet Group, ticker CRCL, was a hard no from me in June when it hit $250 a share, instead recommending shares of the Ethereum Mini Trust, ticker ETH, which are now up 65% since then. I still prefer Ethereum on that stablecoin theme, and that's the backbone infrastructure on which it's going to be built, but Circle is now looking attractive after that 55% drop. Growth in its stablecoin USDC is expected to boost revenue to $2.6 billion this year, another 24% next year to $3.2 billion. Now, it's still not super cheap at about 10.5 times on a price to this year's sales basis, but that is a big discount to the 20 times valuation it hit in June, and that long-term stablecoin growth should take this one higher. Giving you that bigger picture with the Sector Spider sector tracker. 5 of the 11 stock sectors closed higher last week, with energy plunging on a 3% drop in oil and financials selling off on worries over the economy. Internet and media stocks in the communication services sector did surprisingly well, with Alphabet up 10% after a court ruling spared the company from a forced breakup. Here, all but 3 of the 24 stocks in the sector closed higher on the week, a good sign of breadth for investor sentiment. Looking at a longer trend here, stocks in the consumer staples sector are now the sole losers over the 3-month period, as investors worry that companies won't be able to pass on those tariff costs on to consumers. Higher tariff costs will continue to weigh on earnings over the next quarter, but these companies sell things we have to buy, and a gradual pass-through of costs onto consumers over the next year is going to boost profit margins and bring investors back. Here, I want to look for companies with strong brands and growth before the sell-off that are going to reward patient investors, including Costco, ticker COST, Walmart, WMT, and Altria Group, ticker MO. Updating our stock market outlook, it's still a week out from the September Fed rate meeting, and while the market is now unanimous in its expectations for a cut, we could see data that upends these hopes this week. That's because the Fed has to balance job growth, which it supports with those rate cuts, with its other mandate of price stability. And we could see this week that prices are on the rise. We'll see the Producer Price Index, the PPI measure of wholesaler inflation, first on Wednesday, followed by the more widely followed Consumer Price Index, the CPI report, on Thursday. Last month, the CPI measure was surprisingly good, with just a 0.2% month-over-month inflation and 2.7% over the year. That helped stocks rally on the idea that inflation wasn't getting bad enough to derail the Fed from cutting its rates. But then came a shockingly bad PPI measure, showing wholesale prices jumped 0.9% over the month, the highest inflation in 3 years, and 3.3% over the year. So the question this week will be, which one of those inflation reports is going to be a one-off and which is going to show a trend? With the PPI on Wednesday, we should see some of that monthly rate come down quite a bit because some of last month's jumps were one-off broker fees that are going to be reversed out. That could give the market a false sense of hope, and I expect stocks to rally on the news. Thursday, though, we're likely to see that consumer prices have jumped 3% over the last year. It's well above the Fed's 2% goal for inflation, and we'll have investors again worried about those rate cuts and could weigh on stocks to close the week. Get your $150 off our Ultimate Options course. See all 29 option strategies, get the Strategy Finder and the calculator to show you exactly how much you'll make, all with a 14-day money-back guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.